Preparing for a wealth management at Bank of America interview. You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share. And drop a topic request in the comments. Question 1. Why are you interested in Bank of America Wealth Management? Bank of America's wealth platform is compelling because it combines Merrill's advisor network, the private bank's high net worth capabilities, and Bank of America's balance sheet. I'd position the business as advice-led, not product-led. Understanding client goals, building holistic plans, then connecting investments, banking, lending, trust, and estate solutions. That integrated model matters because wealthy clients rarely have isolated needs. They want coordinated advice delivered with discipline, trust, and responsiveness. Make sure to cover Merrill, the private bank, integrated banking and investing, and why Bank of America's scale matters. Tie your motivation to client service, planning, and long-term relationship building. Question 2. How would you explain the difference between wealth management and asset management? Wealth management starts with the client's full financial life, while asset management focuses mainly on managing investment portfolios. In wealth management, I would discuss goals, cash flow, taxes, estate plans, lending needs, risk tolerance, and family dynamics before recommending an allocation. Asset management is one component within that broader relationship. The best answer shows I understand the advisor is not just selecting funds, they are coordinating advice around long-term client outcomes. In your answer, talk about scope. Contrast investment management with holistic advice across planning, credit, estate, tax awareness, family needs, and behavioral coaching for clients. Question 3. How do you assess a client's risk tolerance before recommending an investment strategy? I would not treat risk tolerance as a simple questionnaire score. I'd separate willingness to take risk from capacity to take risk. A young executive may tolerate volatility, but a near-term home purchase lowers capacity. I would ask about goals, time horizon, liquidity, income stability, prior investing experience, and reaction to drawdowns. Then I'd translate that into a portfolio range and revisit it when circumstances or markets change. While answering, focus on the difference between risk tolerance, risk capacity, and risk need. Mention time horizon, liquidity requirements, behavioral reactions to loss, and how documentation protects both client and advisor. Question 4. A retired client has $5 million and wants stable income. How would you approach the portfolio? For a retired client with $5 million, my first priority is protecting lifestyle cash flow without abandoning growth. I'd segment assets, near-term spending in cash and short bonds, core income in high-quality fixed income, and longer-term capital in diversified equities and possibly alternatives. I'd also review taxes, healthcare, estate wishes, and inflation risk. The portfolio should fund withdrawals through market cycles, not just maximize expected return on paper. Be sure to mention income needs, withdrawal rate, capital preservation, inflation protection, diversification, tax considerations, and liquidity reserves. Avoid jumping directly to products before understanding the client's full situation. Question 5. What would you say to a client who wants to sell everything during a market downturn? In a sharp sell-off, I would slow the conversation down and anchor it to the plan we agreed on before markets became emotional. I'd acknowledge the client's concern, show how the portfolio was designed for volatility, and quantify whether their goals are still on track. If rebalancing creates an opportunity, I'd explain it carefully. The key is not dismissing fear. It is converting fear into a disciplined decision framework. While answering, focus on empathy first, then discipline. Cover behavioral coaching, revisiting the financial plan, stress testing, rebalancing, and avoiding emotional market timing that can damage long-term outcomes. Question 6. What does regulation best interest mean in a wealth management role? Regulation best interest means recommendations must be in the retail client's best interest, not merely suitable. Practically, I'd consider costs, risks, alternatives, conflicts, and the client's profile before recommending a product or strategy. Disclosure alone is not enough if the recommendation is poor. In a Bank of America wealth setting, I document the rationale clearly, escalate conflicts when needed, and make sure the client understands why the recommendation fits their objectives. Make sure to cover best interest obligations, disclosure, care, conflicts of interest, documentation, and why recommendations must match the client profile rather than simply satisfy a sales objective. Question 7. Why are KYC and AML procedures important in wealth management? KYC is the foundation for both good advice and regulatory control. I would gather identity, source of wealth, investment objectives, liquidity needs, risk profile, tax status, and any unusual transaction patterns. For AML, the goal is to detect and escalate suspicious activity, not investigate it personally. Strong KYC protects the firm, but it also improves advice because I understand who the client is and what constraints matter. In your answer, talk about client identity, source of wealth, suitability, suspicious activity escalation, regulatory risk, and how strong onboarding supports both compliance and better financial advice. Question 8. How would you explain asset allocation to a client with limited investment knowledge? Asset allocation is the primary driver of portfolio risk and return. I'd explain it as choosing the mix of equities, fixed income, cash, and alternatives that best matches client goals. Equities support long-term growth. Bonds provide income and ballast. Cash covers liquidity, and alternatives may improve diversification. Security selection matters, but if the allocation is wrong for the client's horizon and risk capacity, the portfolio will probably fail. Be sure to mention matching investments to goals, balancing risk and return, diversification across asset classes, time horizon, and why allocation usually matters more than individual security picking. Question 9. How can taxes affect investment recommendations for a high net worth client? Tax efficiency matters because clients keep after-tax returns, not headline returns. I would consider asset location, tax loss harvesting, municipal bonds, charitable giving strategies, and timing of gains. For example, placing tax-inefficient income assets in tax-advantaged accounts can improve outcomes without adding market risk. I'd be careful not to let tax avoidance override investment discipline. The goal is better after-tax wealth aligned with the client's plan. While answering, focus on after-tax returns, asset location, tax loss harvesting, municipal bonds, charitable strategies, capital gains timing, and coordination with tax advisors without pretending to give tax advice. Question 10. How would you build trust with a client who is older, wealthier, and more experienced than you? With an older or more experienced client, I would not try to impress them with jargon. I'd earn trust by listening carefully, confirming facts, following through quickly, and being transparent about what I know and what I need to research. I'd also respect existing relationships and avoid pushing products. Trust builds when clients see consistency, accurate work, clear communication, and recommendations that fit their interests rather than my agenda. Make sure to cover humility, preparation, active listening, reliability, confidentiality, clear follow-up, and using senior advisors or specialists appropriately instead of pretending to know everything. Question 11. How would you use Bank of America's broader platform to serve a wealth management client? Bank of America's advantage is the ability to connect wealth advice with banking, lending, and planning resources. A client selling a business may need investment management, liquidity planning, credit solutions, philanthropy, estate structuring, and family governance support. I'd first diagnose the need, then bring in the right specialists without losing ownership of the relationship. The value is coordinated execution, not simply handing the client to another team. In your answer, talk about integrated banking, Merrill investment capabilities, private bank resources, credit, trust and estate planning, business owner services, and coordinating specialists while preserving relationship accountability. Question 12. What role can alternative investments play in a wealth management portfolio? Alternatives can play a useful role, but they are not automatically appropriate for every wealthy client. I'd explain potential benefits, such as diversification, private market exposure, or income, alongside trade-offs, illiquidity, fees, valuation lag, complexity, and suitability requirements. I'd size the allocation based on the client's liquidity needs and risk profile. In an interview, I'd show balanced judgment rather than presenting alternatives as a magic return enhancer. Be sure to mention diversification, return potential income, private markets exposure, illiquidity, fees, valuation complexity, suitability, and why alternatives should be sized carefully within the overall plan. Question 13. A client has most of their net worth in one company's stock. What issues would you raise? A concentrated stock position creates both opportunity and hidden risk. I'd first understand the tax basis, restrictions, emotional attachment, income needs, and whether the client's employment is also tied to that company. Solutions could include stage sales, collars, exchange funds, charitable giving, or borrowing against the position where appropriate. I would frame the discussion around protecting the client's broader financial life, not simply telling them to sell immediately. While answering, focus on concentration risk, tax basis, liquidity, emotional attachment, employment exposure, diversification strategies, hedging tools, charitable planning, and sequencing decisions thoughtfully. Question 14. How would you approach prospecting and building a client base in wealth management? I would build relationships through credibility, consistency, and targeted outreach rather than generic selling. That means identifying client segments I can serve well, asking thoughtful discovery questions, following up with useful insights, and earning referrals through excellent service. In a Merrill-style advisory environment, business development is a long game. People trust advisors who understand their goals, communicate clearly, and stay present before there is an immediate transaction. Make sure to cover relationship-driven business development, referrals, niche targeting, credibility, disciplined follow-up, community presence, ethical boundaries, and the difference between selling products and earning advisory trust. Question 15. Give me your current market view and how you would communicate it to clients. I'd keep the view simple, balanced, and tied to client action. For example, I might say markets are weighing inflation, rates, earnings, and geopolitical risk, so diversification and liquidity discipline remain important. I would avoid pretending to forecast every move. Then I'd translate the view into portfolio implications, rebalancing, duration exposure, equity concentration, or cash deployment. Clients value perspective most when it helps them make calm decisions. In your answer, talk about rates, inflation, earnings, valuation, diversification, humility around forecasting, and translating macro views into practical portfolio actions instead of making bold predictions. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.